And you're off.
Okay. Good morning, everybody, and welcome to the Kushner Report for September of 2024. At the conclusion of the presentation this morning, you'll have an opportunity to participate in our Q&A session. And the last time we got together was about a month and a half ago, and so a lot of activity has taken place. So there'll be a lot to talk about this morning. Okay, Robert, there we go. So the agenda this morning will be to talk about key economic indicators, the global economy, the domestic economy, mergers and acquisitions, other significant economic news, and then what's ahead in 2024. Today, we're going to look at venture capital and we're going to look at private equity. So what is venture capital? Well, essentially, venture capital is a form of private equity and a type of financing that investors provide to startup companies and small businesses that are believed to have long-term growth potential. A venture capitalist basically doesn't always have to provide money. In many cases, they'll provide technical and managerial expertise with a firm to help them get the company organized and get it off the ground. And again, venture capital is really a subset of private equity. And we've seen this going back to the beginning, which started after World War II. And if you look at there's some key takeaways here. And first of all, venture capital is really a term to describe financing, really provided to companies and to entrepreneurs that want to get started with venture ideas. And then, of course, we look at the capitalists and they provide capital financing and technology expertise and or managerial experience on an as-needed basis. And they can also provide different types of funding and contacts, if you will, for seed money as well. One of the key things that of interest is there really six major stages of a venture funding. And first of all, you have seed funding, and that is basically raising needed money to prove an idea. And that is at the very outset of something where you'll present your business plan, the idea is there, and then there should be some interest on the part of the venture folks to move forward with it. Then, of course, you have startup, and that is it's the cost associated with the marketing and product development, whether it be software or hardware. And then you have a Series A fund, which is for sales and marketing efforts moving out into the community. And then, of course, then you have a second round. And that is where capital companies are now selling a product, no profit at this point, but they're starting to get traction in the marketplace. And of course, then you have expansion. And the expansion, for example, will be whereby we're looking in terms of the company now has new customers and they're moving towards profitability. And then the final stage is where there's an exit by the capitalists, and that is where they provide the company, hopefully, to go public. In many cases, they'll also negotiate deals for them to get acquired through an M&A transaction. And there's really a difference between an angel investor and a venture capitalist. You know, the venture capitalists are really investment firms that have raised pools of capital. An angel is an individual. It could be Harvey Finkel is willing to put up between $300,000 and $500,000 into a company that he believes that it has a great idea and a great area for expansion. So they'll invest. And in some cases, there'll be multiple angels putting money up as well, but much less than venture capital and private equity. And of course, you know that California is really the mecca for the capital venture companies. And out of the top 10 in the United States, 7 are located in California, primarily the Bay Area, such as Sequoia Capital, Andreessen Horowitz, Kleiner Perkins, Excel, and also Greylock Partners. There's really looking now at 5 major trends that are taking place this year. First of all, there's been a shift to a focus on practical applications. And that is, it's a real focus now on green technologies abound, from optimizing energy uses to streamlining transportation systems to curbing carbon emissions. So there's a whole new litany of areas that we're moving into. There's also a focus on the area of AI and blockchain remains very strong. And really, the company marketplace is anticipating that this area will achieve between 37% at least between now and 2030. So this is a huge area of application and investment going forward. And then the new startups might expect more cash. Well, last year, investors allocated a lot of resources to help their current portfolio companies stay alive, keep afloat, and work with a challenging economic environment versus investing in new companies. So it's a lot of it's been inward. And of course, you have beyond VC funding, and that is the area what's called M&A as an option. And my days in the Bay Area, you'll see where companies figure they've gone as far as they can go, and next step would be to either sell their product that they have or to go out and become acquired as part of a strategic move by a major investor. So it might not be enough for them to be able to go public or get acquired. So the next step is to look at any options they have going forward. VCs are primarily looking to do now is they're looking traditionally methods of going forward and looking at the past and the present, and they're really focusing now on more governance and funding, and also looking at sustaining companies and looking to mitigate investment risks that we've seen over the last 20 to 30 years. So it's a new game today. And basically midway through the recent forecast that just came out, it's difficult to say that the IPO market has really reopened. There's only been 4 large IPOs completed in the technology space for $17 billion through the first part of the year. And then just 22 companies have completed IPOs through May of this year. So that's fairly low. And on top of the rates and inflation, the U.S. economy did slow in the first quarter, and it's kind of moving along slowly going forward at a slower pace. So we'll see where we go from here. But there's a lot of market uncertainty. And companies are not dissipating the fact that there's a lot more risk going forward, but the market has a lot of money sitting on the sidelines looking for improvements, especially in terms of reducing rates, if you will, in the marketplace, mortgage rates, and basically the Federal Open Market Committee reducing rates, as we just saw recently. Now let's take a look at private equity. So what is private equity? Well, it's really a form of financing where money or capital is invested in a company. Now, typically, these investments are made into mature businesses and traditional industries, as we see an exchange of equity or ownership stake in the company, in some cases taking debt as well. How does it work? Well, the investment group gets together and they form a pool. So, for example, Ed may go out and get 10 people to raise, let's say, $2 or $3, $4 billion, and then they'll be set to go out and look in the marketplace for companies that look like there's a possibility of some good new products, good new scenarios, and they'll move forward with looking into those for investment purposes. And there's really 3 stages, if you will, of private equity investments. First, you have what the buyout is, and that is when an investor purchases a stake in the company. You know, most common deals are leverage buyouts, and the leverage company, for example, in 2021 was around 66%. But here, the leverage is basically to try to control the stake in the company and taking an equity position, with the portion of debt as well. Then you have the growth stage, and that is that sometimes instead of purchasing a major stake in a company, an investor will acquire a minority stake looking for further growth in the company. And of course, you have the mezzanine level, which is unique to private equity. It really bridges the gap between debt and equity. So when a company receives mezzanine financing from private equity, it really takes on debt and capital with the agreement to pay it back with interest. So essentially, that means that the debt can also be converted to equity in the company. So what is a private equity firm? Again, as I said earlier, the firm is really, it's a type of investment firm. The investment is in business. The idea here is to attract and develop and insert value into companies that have long-term opportunities going forward. Unlike the VC firms, private equity firms take a majority stake. In many cases, it's greater than 50% ownership in a company, and they'll continue to invest until that company decides either to sell it or perhaps the company will go public if they're privately held. So how does a private equity firm make money? Well, there's 2 ways. First, you have a management fee and you have performance fees. So a management fee runs around 2%, and that's fees basically to cover daily expenses and overhead that are incurred on a regular basis. And then, of course, you have a performance fee, and that is its calculated percentage of profits from investing, and typically around 20%. And these fees are intended to incentivize greater returns by the company and are paid out to employees to reward them for their successes. So what are some of the top private equity firms in the country? If you look at these here, look at the geography. You've got Blackstone from New York, TPG Capital from San Francisco, the Carlyle Group from Washington, D.C., and Harbor Group from Boston. These companies are talked about all the time when you're talking about the big players in private equity, and they've been very, very successful with all the companies that they've been investing in throughout the last 20 to 25 years. So what is a private equity investor? Again, it's an investor working for a firm that's called an equity investor. And again, it's all about raising capital and managing that capital to generate strategic returns for those that invested in a leverage situation. And of course, there's limitations, and the real key is to pay back the limited partners substantially, anywhere from 20 to 25%. And then you have PE firms versus mutual funds. So the biggest difference between the two is this: mutual funds are really accredited, and they really deal with looking into terms of publicly traded companies. And mutual funds are the only allowed to collect management fees, whereby a venture firm, private equity firm, can't collect performance fees. So let's take a look, for example, at the midterm outlook for 2024. What we're looking at now is this: there's really 5 key areas of emphasis going forward in the area. And first of all, as all of you know, artificial intelligence is a major play. And this disruptive force is at the top of every leader's list. Companies must really look forward to, with artificial intelligence, to avoid falling behind competition. And in 2024, private equity firms will expand their use of artificial intelligence. We anticipate that AI implementation will quickly shift from just automating back office functions to automating enterprise scale platforms. And that's taking place on a really rapid basis throughout the country. Infrastructure is another area. And then basically investment of the Jobs Act, which will generate $1.2 billion in federal funding over the next 5 years, coupled with the Inflation Reduction Act and other areas, will help incentivize areas into clean energy and also into broadband. So in 2024, if you will, infrastructure, primarily energy infrastructure, will continue expanding as an asset class for private investments, allowing more diversified products and funds to match investment opportunities and applications. And then we have value creation, and that is strategic and operational improvements will continue to be the largest source of PE returns. With opportunities for exits currently lower than historical averages, firms are zeroing, if you will, on efforts to really create portfolio value for those companies, to get them off the ground and increase profitability. And then finally, we have working capital, and that is most portfolio companies have enormous opportunities to improve many areas of working capital, especially optimizing operational areas such as supplier terms, running down old stock areas, and factoring some of the debt and book. So the idea is to really take an inward focus on generating cash. And lastly, we have retail market expansion, and that is the private equity firms will continue to experiment and develop expanded opportunities via the retail channel. And retail investors have the same attraction as professional investors of asset class resistance. So you'll see more of that taking place. And in addition, you're going to see more M&A deals taking place going forward, because if we have slow organic growth, there's a lot of opportunity for companies to expand their portfolios as well. In summary, private equity firms really focus on the 5 trends that we discussed a few minutes ago, such as artificial intelligence, investments in infrastructure, and also energy products. So we're moving in that direction, and that will continue, and that will be expedited as we move into 2025. So again, we look at, for example, the difference between private equity and venture capital. Just a finite. So it's again, the PE firms typically invest in mature businesses, and that is traditional industries that we see out there. And they use capital committed from limited partners where they've raised funds to have a pool to set aside and invest. And then when a private equity company sells one of their company portfolios, they'll return monies back to the limited partners. And this could receive at least 20 to 30% return on their investment, while the limited partners will get 80%. And the uniqueness in venture capital, again, it's their funds to initially set up small, young companies with seed funding to get them off the ground, to work with entrepreneurs that have great ideas to move companies forward. And of course, then you have the area where the VCs come in, take a stake in the company, and also will help to insert management expertise as well as technical expertise whereby it's needed. So now I'd like to take a look at the key economic indicators. So we'll take a look at the gross domestic product, inflation, unemployment at the federal and the California level, and then we'll look at the price per barrel of oil. So the outlook for the global economy has been generated, moved up a little bit to 2.9%, and we're looking at 2.8% in 2025. And the U.S. economy is looking to go at about 2.3% this year, and then dropping down to 1.9% next year. And that's based on the stability and the effectiveness of our economy. And again, those will change as we get into January of next year with the 2025 economic forecast. If you look at the inflation rate, we're looking at going out the end of the year across the country around 3.1% and dropping down to 2.6 next year. And unemployment rate is looking to go out nationally around 3.9% and then 4.2 next year. Unemployment in California is looking at 5.1% and then dropping down to 3.9. Keep in mind, California's economy is usually the first or the last to slow down and the last to come back on board when a recession or mild softness occurs. I want to make a comment about the oil situation here. This will make your days. You know, this is a very, very volatile area. So this morning, the price of oil for West Texas Intermediate is $67 and change. And so the range is looking more like next month when we do the program, somewhere between $70 and $80. Now, the Middle East has agreed to tamper their expectations on $100 a barrel, and they're going to be backing off on that. Keep in mind, China is using less petroleum now than they have in a long time for various reasons, slowing economy, and they're moving more to insert more of electric vehicles that they're manufacturing within their own country. So the global economy has some very interesting things, and there's a commonality here. First of all, the Japanese recovery was in reach. We've seen an increase by 13 points within their economy, so they're moving in the right direction, which is good news. England, for example, along with the Bank of Canada and the Bank of New Zealand, all of these companies have dropped interest rates by 25 basis points before we had our decision made a couple of weeks ago. So we're seeing all that taking place. In China, the economy continues to slow, and the rate is looking more like about 4.7% growth this year. So their economy is not strong. It's down substantially. And of course, the surprise was that the Bank of Japan is tightening monetary policy. They just raised their interest rates slightly. And of course, the Swiss bank, same thing, 25 basis points, and the European Central Bank is doing the same. So all of these areas have dropped their interest rates by 25 basis points, and that will continue throughout the rest of the year. Now, looking at the domestic economy, what we're seeing, first of all, the inflation is cooling in the United States. It's dropped down, and of course, you know that we've dropped interest rates here by 50 basis points. And if it continues, we may see one or two more rate cuts before the end of the year. The gross domestic product came out at 2.8%, which is much higher than expected, and it was a very strong second quarter. And keep in mind, October 1 is the beginning of the fourth quarter, and then the third quarter is finishing up on 30th of September. Then we'll get an idea how the third quarter did, and then looking at the bulk and the projections for going out the end of the year. Again, as I said earlier, the Federal Reserve moved market rates up by 50 basis points. And again, that's good. It's dropping some rates, and we'll talk more about that in the latter part of the report. The California's economy continues to struggle. They're contending with a number of challenges. So you've got payroll growth has really tightened. Monetary policy has really generated a pullback in hiring. And several of the state's interest rate sensitive industries, notably manufacturing, finance, and technology, have really suffered over the last several months. And U.S. Basically commercial real estate market is really headed toward a crisis. We've talked about the market in this area not turning around really until 2020. Well, right now, more than $1 trillion in loans are coming due in the short term by the banks. And most of the focus is now is reducing rates on properties. Again, a lot of companies will consider if they can't reduce rates, they either want to subcontract some space that they don't need or even move to other locations. So that's forthcoming. So looking ahead, let's take a look at inflation. Inflation inched up to 0.3 of a point in August, and that's the fastest rate we've seen increase in the last 4 months. And hopefully that's not a sign that it's going to continue to move in the wrong direction, because that'll have an effect on interest rate cuts going forward. In the wholesale marketplace, we saw the rate go up by 0.2 of a point. That's higher than was expected. When we look at trade exports, we had a solid month in July. We're up by almost $267 billion. That's an increase over what we saw in the month of June. And the trade deficit is 73 billion this month. It's a little bit lower than what we saw in July. The good news is it's substantially lower than the 90 to 100 billion that we were seeing last year and the year before that. Retail sales surprise growth. Again, it's pointing to still resiliency in the economy. It grew by 0.1 of a point in August, and the core sales rates were up by 0.3 of a point. So people are still spending money on various things. Now let's take a look at the jobs report. So first of all, in the U.S. across the board, we saw the creation of 142,000 jobs in August. And the good news is the unemployment rate dropped down to 4.2%. If you look at some of the categories, the real key ones here are, one is construction, 34,000. I've talked about government, which again is basically overhead. And then you look at finance and the area of health and education. The information services space, which is really technology focused, again, the loss of 7,000 more jobs. Manufacturing took a major hit last month. They lost 24,000 jobs, and retail was down by 11,000. But again, it was only 142,000 jobs. They do not break down the difference between a full-time position and a part-time job. All of that's inclusive in the 142,000. Now, you take a look at California. This is one of the lowest rates that we've seen in a long time. There's only a creation of about 6,800 jobs in August, and the unemployment rate inched up to 5.3%. The key here is construction was down by 3,300. Government was down by 2,200. But information, the technology space, again, took another hit of 5,100 jobs. The good news is, or the bad news is basically is manufacturing took a hit in California by 4,700. So again, it was extremely anemic in the month of August for the jobs report. I want to go back one page for a moment. Go back one more. I have a couple more things I want to talk about on the bottom of the other one. Go ahead. So what I wanted to cover now is interest rates, and that is, as I mentioned earlier, they dropped it by 50 basis points. So the range right now is between 4.75% and 5%. And that's kind of where we are right now. And that's down from the 5.25 that we saw over the last several months. The mortgage rate, here's some good news. It closed out late last week at 6.09%. It's still high, but it's starting to come down. So there's getting some traction there. Now, the manufacturing sector, again, is at 47.2, and expansion continues. We're still in a contracting mode. This has been going on now for some time, and expansion has been down over the last several months. Again, we talked about a target level of 5.0. When you're above 5.0, you're growing, you're expanding. Right now, we're contracting, and that's unfortunate. That's where we are right now. Now, the one thing I wanted to talk about is on the area of the mortgage area rates, as I just mentioned, in manufacturing. So we'll go to the next slide then. So let's take a look at factory orders. The good news is it increased by 5% during the month, and that's one of the highest monthly rates we've seen in a long time. It's up to about $592 billion, which is very good for the economy. In the area of small business confidence level, index fell by 2.5 points. It's down to 91 index. And again, this is the 32nd month in a row that we've seen it below 98. The real target is to be at 100. And again, you can see where we are from that perspective. We've got a long way to go to move that in a different direction. And what's interesting here is consumer confidence rose a little bit to 103. So the consumer is still spending money, still looking at some resiliency in the economy. So they're still moving ahead, spending a lot of money, using a lot of credit cards. When we look at crude oil prices, I said earlier, late in September, about a week ago, it was at $72.45. This morning, it's at $67 and change. So we're talking $5 within the last week and a half. It's amazing. And again, the Middle East is talking about OPEC about dropping their target level of $100 a barrel, dropping that down. So we'll see. So right now we have a good supply of oil throughout the world. So that's good news for all the consumers and companies as well. If we look at housing starts, the housing starts uh, took a sharp increase, if you will, or rebounded by 9.6% in August, which is good. Very good barometer for that. So that's moving in the right direction. When we look at new home sales in August declined by 4.7%. And a lot of it is tied to the high interest rates and along with some uncertainty in the economy going forward. So we'll see when that's going to go in a different direction. So let's take a look at Southern California specifically. So in Los Angeles, the median price of a home, those that are on the market, is around 920,000, and that sales price increased by 1.2% last month, while sales decreased by 3.2% in the market. And then from July was flat from August of 2023. When we look at Orange County, we had $1.4 million was the sales price of a home, and that's up about 0.7 of a point. But sales were down by 6.5% during the month, and then we're down by 7.3% from from August of 2023. And in San Diego, the price of the unit was $1,010,000, and that decreased by 1%. So we saw that decrease, and then of course it was down 4.7% from last month, and it was up 3.2% from August of last year. So the market is still moving along. The inventory is pretty slow. We'll see what happens going forward. Now, when we look at existing home sales, and some people are on the call are looking to sell, they fell 3.1% in August. And basically, it's down quite a bit from August of last year as well. So it continues to be a slow market for existing homes. When we look at construction spending, it was down by 0.3 of a point during the month. So there's been a pullback. Good news here is in productivity. The second quarter productivity inched up by 2.3% in the second quarter. And that is, we saw an increase in output by 3.3%, which is very good. And also hours worked were up by 1%. So we're moving in the right direction in terms of productivity. Now, company displacements is typically, I only want to talk about companies that have had significant layoffs during the month. So first of all, we had a lot of companies have announced cutting costs, if you will, and eliminating positions. So we've got a company called Stellantis Warren Truck Plant. It's in Detroit, and they just laid off 1,600 people. There's a firm in Boston called UKG. They provide HR services and resource management, 2,000. Nike, senior level positions, 783 across the board. Intuit, Bay Area, 1,800. GE Appliance was 1,000. Redbox, I'm going to talk more about them later, 1,000, and they filed Chapter 7 bankruptcy. We have Warner Brothers, Discovery, 1,000. Mercury Marine, which is a boating company located in Wisconsin, 1,700. Nike, another 4,300. Intel, which was a real surprise, 15,000. Michelin, 1,000. Paramount Global, 2,000. And Stellantis plant in Nevada, 2,400. Cisco Systems, another 5,500. General Motors, 1,000. LegalZoom, which is a legal services firm, 1,000. And Goldman Sachs, 1,300. And then last week, Price Waterhouse, 1,800. So you can see there's cuts going on of significance still across the country. The M&A place this last month was huge. I mean, we saw a lot of deals in different segments. Again, you're seeing more consolidation in certain industries, and you're seeing companies that have very small organic growth are looking to move forward. So Honeywell, for example, is buying CA Systems for $1.9 billion. And this is an acquisition that will enhance their defense technology solutions really across land, sea, air, and space. So that's a major move for the defense contractor. Boston Scientific is still active. They're buying Silk Road Medical for $1.16 billion. Basically, it's a California-based company that designs products to prevent patients with artery diseases. So this is a major input for them. Boeing, as you know, is acquiring Spirit Aerospace Systems for $4.7 billion. And again, the announcement here is it looks to address and resolve a lot of the recent safety issues and concerns. And then the parent of Saks Fifth Avenue is buying rival Neiman Marcus. And what that's going to do is the new entity is going to create one of the largest luxury powerhouses at a time in the arena when more consolidations are taking place. So those are two major names on the board for that. Nanodimensional is acquiring a company called Desktop Metal. It's a digital company involving one of the biggest names in additive manufacturing. And then we have Nokia is acquiring Infinera for $2.3 billion. And the deal really strengthens Nokia's position in the optical network area in advancing their optical technology. It'll help the Swiss company, the Finnish company really, in telecommunications and electronic solutions and new products coming to market. And then we have Devon Energy is buying Grace Mills for $5 billion. And this is a significantly position in the Williston Basin. KKRP, which many of you are familiar with, they're buying Varsity Brands from Bain Capital for $4.7 billion. This is a U.S. maker of sports uniforms and school yearbooks. So it's an interesting area for them to move into. Google has made a major decision. This is the largest acquisition deal they've ever made for $23 billion. They're buying a company called Wiz, founded in 2020, San Francisco-based company. It was eyeing doing an IPO as recently as May, and this will give cloud security technology for cyber, etc., more impotence by being incorporated into Google's platforms. So that's a major increase for Google. And then Mr. Cooper, which is a flagship of bank mortgage company, is in the process of buying Flagstar for $1.4 billion as they expand their foothold in the mortgage business. And CBiz, which is one of the top accounting firms in the country, is buying a company called Markham, and it's going to buy their non-attest area business to solidify their position in the professional services marketplace. AMD is still around and doing well, and they're buying a company called ZT Systems for $4.9 billion. Again, it's expanding their portfolio of products and services in the market. And Verizon is active again. They just bought Frontier for $20 billion. And that's going to be a strategic investment in a pure play going forward. Very active in the M&A space. Now, taking a look at other significant news, a lot going on. So the first thing we saw was California. Chevron is relocating its corporate offices and headquarters to Houston, Texas. You can see now that the company now has over 7,000 people working in Houston. This movement of the corporate office from Chevron marks the fact that there will be no corporate offices for major oil companies outside of Texas. Everyone is relocated to Texas. And we saw that in California, 2,000 jobs, most of those jobs will be relocated. They will keep some activity here to manage and monitor the refineries that they still have and own in California. They will also be selling most of the space that they had in the Bay Area up north. This is a surprise. Apartment starts have plummeted by 52%. No rhyme or reason, but they're down substantially. And then we look at Albertsons and Kroger. We've talked about this. The merger would have been huge. And unfortunately, the deal is worth $25 billion. It's been put on hold, and it's probably not going to go forward. There's a number of lawsuits to block this by states all over the country, including the state of California, because they feel that it's going to limit the activity of the markets in food services. State Farm is seeking a 30% rate increase in the state of California. In California, 1 out of every 5 homes is insured by State Farm. And basically, the rate is increases is a sign that the company is really struggling financially. We'll see where that goes. And then Tinker Toys is filing bankruptcy. So a company called Basic Fun Incorporated, which is a seller of children's products, including Lincoln Logs that we've all played with as kids, and Tinker Toys has filed Chapter 11 reorganization, which is unfortunate. And Moody's is predicting that 24% of office towers will be vacant by 2026. And it's another grim impact on the commercial real estate market. Again, the pulling back. And then we look at credit card delinquencies, and it's surging, especially in the state of California. It's now at the highest rates that we've seen ever because of inflation and everything else. People are living on credit cards. So the debt is it's monumental going forward. And then I mentioned earlier, Redbox, for any of you that have ever rented a DVD from a supermarket or Walmart or someplace, unfortunately closed everything. They went through Chapter 7 liquidation, eliminated 1,000 employees. Now, go back to 2013. They had over 40,000 kiosks, and the company had $1.97 billion in revenue. And that's what's happened in the last 11 years. Elon Musk has announced he's moving his headquarters of SpaceX and X to Texas. It's another move on the part of moving company moving out of California. Now, this is something interesting. A study just came out that data said that the Tesla Model 3 will depreciate 45% after 3 years, while a gas-powered Toyota RAV4, for the comparison, will depreciate only 22%. And a report just released last week by McKinsey and Company found that globally, 3 out of every 10 electric car owners will be switching back to gas-powered vehicles on their next purchase. So I found that was quite interesting. CVS, their health, they're struggling. They're going to have got to cut $2 billion in costs. They're closing some of their stores, and they're going to start using more AI and other kinds of technology to reduce operating expenses and improve operating efficiency across the board. Basically, the key here is to streamline process and optimize operations. LL Flooring, which is, many of you remember, a company called Lumber Liquidators, has filed Chapter 11 bankruptcy. They're also looking for a buyer of the company. Nordstrom's, for those of you that shop at Nordstrom's, they're closing their LA and their Chicago offices. Basically, they're letting the leases expire, citing the fact that the usage of the space is a primary use, and it's down substantially. They no longer need these. They're cutting operating expenses. Good news on Rite Aid. Rite Aid is coming out of bankruptcy, and they're going to be a privately held company going forward. And the last comment that was made was that FedEx announced this week that they're going to be raising rates by 5.9% beginning January 6th of 2025. And that's, according to them, is an average increase. So that takes us through other significant activity. So what I'd like to do now is open up for questions and answers. So we'll unmute everybody. And what
Good morning, Dennis.
Yeah, Jim.
I want to go back to the very beginning of your